The one decision that still looks right years later. Introduction. In investing, most decisions fade with time. Some look brilliant briefly, then average. Others feel painful at first, then wise. But occasionally, years later, an investor looks back and realizes, one decision changed everything. This research explores the psychological structure, financial impact, and long-term characteristics of the rare investment decision that remains correct even after many years. 1. What makes a decision timelessly right? A decision that still looks right years later usually has three qualities. It was aligned with long-term fundamentals. It survived volatility. It benefited from compounding. Unlike short-term trades, these decisions gain clarity over time rather than losing it. Time becomes confirmation. 2. The power of long-term ownership. Historically, transformative wealth has often come from owning productive assets over long periods. Early shareholders of companies, like Apple Incorporated or Amazon, who held through volatility later described their decision as obvious, in hindsight. But at the time, the future was uncertain. Drawdowns were painful. Doubt was widespread. The decision felt risky before it felt right. 3. The role of conviction. Behavioral research by Daniel Kahneman shows that humans struggle with uncertainty and loss aversion. Most investors abandon good decisions during temporary discomfort. The one decision that survives years usually required emotional endurance, tolerance for criticism, resistance to short-term noise. Conviction, not intelligence, often made the difference. 4. Compounding as the silent multiplier. A decision becomes obviously correct when compounding has time to operate. For example, 10% annual return over 2 years feels modest. 10% annual return over 20 years becomes transformative. Time converts good into extraordinary. As emphasized by long-term investors like Warren Buffett, the real advantage often lies not in finding something spectacular, but in staying invested long enough. 5. The psychological shift over time. Years later, investors often realize the hardest part was not buying. The hardest part was holding. The biggest risk was selling too early. Memory simplifies the struggle. Hindsight removes the anxiety. What once felt uncertain now feels inevitable. 6. The common patterns behind the one right decision. Across markets and generations, these decisions tend to share patterns. They were unpopular at entry. They required patience during flat periods. They survived at least one major correction. They were thesis-driven, not trend-driven. The decision aged well because it was structurally sound, not emotionally reactive. 7. Why there is usually only one. Many investors report that over decades, only 1 or 2 decisions truly transformed their trajectory. This reflects a reality. Great opportunities are rare. Extraordinary compounding requires uninterrupted time. Emotional resilience limits participation. Most returns are average. A few are exceptional. 8. The deeper meaning. The one decision that still looks right years later often represents more than money. It represents discipline over impulse, patience over urgency, strategy over noise. It becomes proof that long-term thinking works, if lived, not just declared. Conclusion. Years later, clarity replaces uncertainty. The one decision that remains correct is rarely dramatic at the beginning. It often feels uncomfortable, slow, and lonely. But time rewards durability. In investing, the best decisions do not look brilliant immediately. They look obvious, but only after they have survived time. And often, what makes them right is not timing the market, but staying with the decision long enough for time to do its work.